here we want to look at what's happening with the Fed, what's happening with inflation. For those that have been loyal followers and listeners, we've been talking about how inflation was going to accelerate in August, and then we saw it accelerating again in September so far, and that continues to play out. And we really want to look at, well, what are the impacts to that, and how is that going to kind of shift some of these Fed policies that continue to be talked about? So one of the things that we want to look at first is the spread between nominal GDP and nominal GDI, which is just gross domestic income. So but the difference is at a record. So when you look at some of the shifts, the idea here is that GDI is obviously much lower than nominal GDP, and it gives you a bigger, I think, view into the real economy, because you can see nominal numbers and it's like, oh, well, this is so great. But then when you look at the actual money being received, the income on behind it, it's lacking. And for anybody like myself who runs a business or runs multiple businesses, things are slow. People are slow paying. People are slow, turning around, and it's causing hiccups throughout the movement of money through the facilities, through the different entities, which again is slowing down activity and is going to be, I think, a much bigger overhang as we progress through not only just this year, but also into next year. Now, it's an interesting piece when you look at the GDI side and then shift a bit into the underlying consumer. And I thought this was a great quote because it was from Redfin. 38% of recent home buyers under age 30 used either a cash gift from a family member or an inheritance to afford a down payment. Senior Americans, which for those that don't know are 65 and older, are 2 times more likely to be homeowners than young Americans under 35. So whenever you think about, well, how are we going to expand the economy? How, we have a population issue. We have all of these problems. When you look at that GDP versus GDI, it's like, well, how is someone who is, let's call it 28, 29, there is a thing called the nesting. For anybody who has children, who has had their wives go through what is deemed in all of the books as the nesting phase, there's a certain amount, we are animals, we have to have a certain amount of comfort when it comes to where are we going to give birth? Where are we going to raise our children? And in the confines of an apartment, in some of the tightness that's there, not only just physical tightness in terms of actual square footage, but then monetary tightness, it becomes very difficult to say, oh, well, I'm going to have 4 children. As someone who has 3 children, they are massive overhangs when it comes to savings, when it comes to income. So when you look at expansion of growth of population, when you look at an income basis, it's like, well, I can't afford a home, so I'm renting. So instead of earning equity on something, I'm just paying someone else's equity to earn an equity piece. So you get this circular movement in terms of this pain and these underlying slowdowns. And I think that's something that is missed. And then when you factor in inflation, and if you look at healthcare and you look at childcare and you look at food, given shrinkflation on top of everything else, because not only are we talking about prices going up, the volume of what you're buying is going down for the same price. And that is a big problem, because if you're feeding 4 mouths and all of a sudden pasta went from a pound to, 10 ounces, there's a problem. You're still just paying the same price, but now you need, 2.5 boxes to meet the same requirements. Obviously it's not as extreme as a pound to 10 ounces, but you get the idea in terms of kind of where these struggles are. And that's, again, what we're seeing when we look at some of these underlying pieces, which is why when we then look at, 31% of all U.S. government debt outstanding will mature over the next year. So, and this is what we've been talking about. At some point, you get the machine turning off because nobody's going to want debt, or U.S. debt, or at least at this rate, which is why our rates have continued to go up. But that's a huge interest expense. So not only are we going to have to roll this debt, But based on the projections right now, we're going to have to issue new debt on top of the rolled debt. So this creates an exponential increase in our interest expense and what goes to other countries or holders of our debt versus what kind of support can actually go to entities within the U.S. So then the revolving credit in the increase by at 9.2% annualized rate in July, up sharply from prior months, more or less in line with longer term average, though more consistent with average seen throughout the 1980s and 90s. And this is the component that we're talking about in terms of some of the overhangs when we start looking at some of the different pieces for the consumer. So now when we look at inflation, so here when you look at the inflationary piece, the USA CPI, less food, shelter, energy, used cars, trucks, or when the running joke has become the CPI excluding everything, which is what people pointed to when they say, oh, well, if you exclude all of these things, therefore inflation is going down. Well, it is exploded higher. And when you look at the shift in general, now you're just seeing the acceleration on a lot of levels, which is why the CPI excluding everything is a funny way to kind of look at it, because the rebound in CPI inflation to 3.7% from 3.2%, which was largely an energy price story. And for anybody who's been following us, this is exactly what we've been saying. Services are elevated. They're not coming down, not really rising at a huge level, but they're not really coming down either. This is an energy pickup story. Now, when you start looking backwards through that, PPI went up. Why? Because PPI is a leading indicator, and PPI is built on energy costs. Energy costs have gone up, but we don't see it going down. It's going to be here. A lot of these key pieces continue to be elevated, continue to be problematic, and that's going to weigh on people in general. Then when you look at it, there's an increase in airfare inflation, which isn't surprising given kerosene and jet fuel. So inflation for several key services are still slowing. But then when you look at leading indicators, as we've talked about with regional Fed data, and we'll show recent ISM data, and as we showed in the segment 1, well, prices are going back up. We've seen a re-acceleration in prices, and small businesses actually expect prices to go up again, which will weigh on that as well. All the while, Fed policy has twice corrupted the U.S. housing market. So coming full circle, it's like, well, the market was much less overvalued in 2008 on a relative basis. And when you look at this in general, there's the wages, which have started to come up, but actually went up, are actually starting to roll now on not only just a real level, but also a nominal level, while home prices are still here and going higher. Rent is still here and going higher. Prices are going back up. So at some point, that disconnect is going to snap back, and it's either going to be a wage price spiral, or you're going to see a meaningful reduction in asset prices, especially in the housing market. And this is interesting when you look at the debt to income ratio for all home buyers. Now, this is all home buyers. This isn't just new or other. So home buyer debt to income ratio is averaging close to 40% in 2023. Those are near the worst affordability levels on record, according to the FHFA and the calculations of the author from Venture Consulting. Even worse than the 06-07 bubble before the crash. So it's important to look at it in general, because this comes as total household debt just hit a record of $17.1 trillion, and credit card debt crossed $1 trillion for the first time ever. Consumers are borrowing at a record pace, all while savings are declining and rates are rising. So there's two sides to this, because now you have the people that are already in a home. Now, most of these individuals are averaging a mortgage that is below 5%, with a large part of them probably lower than 4%. So their coverage ratios are easy, but their equity has gotten hurt, and we don't see it recovering. We actually see their equity eroding further, which again is going to leave them where they can afford to stay there, but they can't afford to move. But then when you look at it at the same time, the reason why they can't afford to move is because who can buy the house? And that's the next piece that people miss. It's like, this is that golden handcuffs, which is why prices have gone up, because existing home sales have gone down because people are like, I'm not selling my house. So it's going to take the new supply coming on, that new piece, and we have a record amount of 5+ units coming on. We took out the record from 1973. We have a record amount of new rental properties coming online. So it's going to take the new capacity to really start to drive this down. But in the same time, you have many retailers are concerned about safety. So guest on associate violence, organized retail crime. We talked about shrinkage. You've seen the videos, you've seen the problems, you've seen companies that are shutting down in specific regions. So theft has been rising rapidly in retail sector, with Walmart even saying they may need to raise prices to adjust for that inventory shrink. Large retailers say their annual apprehension of shoplifters climbed by more than 50% in 2022. Even more worrisome, 78% of retailers have seen a rise in guest on associate violence. And this is where people are frustrated, people are angry, and they're lashing out. And they're lashing out in a lot of different ways. And I don't think this isn't where people are they are losing some decorum, but there's anger out there. It's contagious at times. And that's where we see some of these frustrations erupt into something bigger. And you just have to look at auto loan transitions to serious delinquencies. It's rising up. People are facing pressure. Now, again, you never know what somebody's thinking. You never know what's happening in that person's life. And unfortunately, more people are falling under hard times. My stress has resulted in stress-induced alopecia. So you can visibly see the stress. Some people you can't. So it's interesting when you look at this, and this is why we wrote the article. We've talked so much about what comes after COVID. And we've been saying financial pressure, financial stress, anger, protests, violence, coups, all of these things are coming to pass. And again, and as we said, it wasn't going to happen during lockdowns. People are locked in and scared. It's not going to happen a year after lockdowns. People are trying to pick up the pieces. Where are we going to go? How are we going to fix things? What's happening? Then once you kind of settle in after a, let's call it 18 to 24 month period, things suck and people are pissed. And we're in 2023. Now is the time where you have max pressure and accelerating. It's not like, we're at the peak amount of pressure, it's coming down. We're at max pressure and blowing through the ceiling. That is a problem. And I don't mean to be preachy, and I apologize if it comes across like that, because I'm hearing it in my head and it sounds like it, but that's the problem that we're facing right now. And that's where it's not something that is going to go away overnight. Households' net worth level contracting for the fourth time. Revolving consumer credit in billions of dollars. You can see that pivot. Households' net worth is contracting for the fourth time since 1990, at a time when credit card debt is above $1 trillion, with rates close to 25%, the highest ever, and credit card interest have soared above that 20%, and again closing because, again, it compounds, and it compounds monthly. So these are things that continue to get much worse. And this is why when we look at the Fed, and I've been saying from the very beginning, I don't understand why they did the mortgage-backed securities, the black line. Why did they do it all through 2020, 2021, into 2022? Where did you see a shortage of home sales? Like, where did you see the pivot? So, but then there have also been the slowest to sell them. So now you see this problem when you look at where things are, which is why QT has been so slow. It hasn't had an impact, and they're going to have to accelerate. Liabilities and capital, other factors draining reserves. Reserve balances within the Federal Reserve have again kind of been stabilized, which is some of the things that we've been talking about, as their cost of operations is steeply negative, and it's actually at something approaching negative 100 billion, because they have to pay out, but again, they're just going to print to pay that out, which also gets in the way of QT versus QE, or quantitative tightening versus quantitative easing. So then again, breaking it down, revolving consumer credit, revolving consumer credit, real credit, and then the revolving consumer credit owned and securitized against disposable income, you get an idea of, again, that max point, but you see the reacceleration, you see that pivot, which is going to, again, bite into where things are as U.S. household NPO net worth, and then the real net worth. You get an idea of some of these pivots as the index of consumer sentiment. So since the pandemic began, Americans have been gloomy despite the stronger economy. But coming back to our first chart, the GDP economy or the GDI economy? Because the GDI economy is talking about what we've been talking about, which is not a recession, but a slowdown, and a meaningful slowdown that's going to bleed into a small recession, but then kind of stay at that depressed level for an extended period of time. So then when you look at the surveys, and markets tend to predict rapid reversion to a perceived anchor rate, but that anchor rate is moving higher. And that's what we've been talking about, where when the Fed starts to cut rates again, which we don't believe will happen for 12 months after the last increase, it's not coming back down to zero. That ZIRP or zero interest rate policy, in my opinion, is a massive failure at this point. I think, I'd have to look at academia, because the ones that I follow from academia have shown, or at least demonstrated, that what the ZIRP created should never happen again. But again, 3.3%, pretty low. It's not like we're going back to 5%, but I think we're going to have to let that market kind of find that level, especially when you consider the amount of debt that is outstanding and continues to be put into the market. So the conviction Fed is done hiking rates in September. The answer for yes is 60%. For me, and I think it's going to be interesting when you see what happened in August, and then again what happened in September, because this data came out prior to the inflation data in August, and prior to obviously what's going to happen in September. So again, we do think that there is that one more rate hike, but even as the thing people are talking about is like, well, U.S. bankruptcy filings are up, therefore everything is getting problematic. Changing credit availability is getting harder. So therefore things are working. It's like, but there's a multitude of impacts, and you still need to let this move through the system. And that's why it's going to take time, and that time is really why you're going to see things hold firm at these elevated levels, which is why that when you start looking at the optimal level of a Taylor rule optimal rate, what does that look like? Well, we're still below that. And I think it's important, because one of the things that we've been saying is we're not going to get to the Taylor rule. I think when you look at what Powell's saying, he's like, look, we could go higher. Based on the a higher R star would imply the policy rate is still suboptimal. So technically we should go higher. But he's going to say, I'm not going to go to where we should be, because I want to stay where we are longer. And I think, in my opinion, that is the right course of action. When you look at what happened in the 70s, when you look at the failures of and then what the 70s led to in the 80s, to avoid those massive ups and downs and the bubble pops happening so close in orientation to each other, this is how you create some of that deflation, which is what we believe to be a good thing in the long term. Obviously, deflation is painful in the near term, but it creates a framework to build off of and a foundation that you can grow from. Over the next 12 months, which of the following loan types, if any, do you expect to have lower credit quality? Commercial real estate, not surprising, with more coming in terms of personal automobile, credit cards, because this is only as of Q2. We do expect personal automobile and credit cards to start to make up a lot of that closing that gap. Loans and leases and bank credit. So the loan to deposit ratio, the LDR, which assesses liquidity rates. So if it's too high, then it means that you might not have enough cash on hand to manage day to day. But if it's too low, well, it means that you're not earning enough money, which then means you can't manage your operations. So you're starting to see some willingness to lend again as people are starting to kind of get comfortable with where the Fed is. And for somebody who's been trying to raise money, the biggest concern is, well, we want to wait to understand the Fed. And what we've been saying since 2020 is, this is what the Fed's going to do. and we are well prepared for it. But again, people need to see it, and we're finally starting to see that shift. When will the Fed first cut rates? 38% are saying in the second half of 24. Again, it depends on when we stop raising. And again, because one of the things that we've been saying is it's 12 months from that stop point. We don't think it's Q2. Let's put it that way. So the small business optimism sales. So now here's a bigger problem is sales are starting to slow at the small business side. So there's an expectation that sales are slowing, and that's going to be a bigger issue when you look at economic growth. And then employment change is starting to pivot down. Small business, but then when you look at price changes, well, price changes started to go up. Price plans went up again. These are two pieces that are driving that inflation, which is why we're saying August is not done. August was the acceleration with September follow through, and based on energy prices, likely in October follow through. So unless we get some bigger pivot, which is going to impact demand even further. Compensation is flatlined but still elevated. Compensation plans, though, is expected to go up. And again, that's where that compensation plans is what the Fed wants to get in front of, because they can't say it, but they want wages to come down further so people stop spending. Stop spending, bring prices down, have more sales, have more, and then create that backdrop, which is why they're trying to get this inflation month-on-month level in check. The Fed updated their inflation nowcast this morning. August CPI is now projected at 0.79. As we know, it came in at 0.7. So we want to look at where things are, how things are setting up, and then we want to look at where are they now in comparison to CPI, core CPI as we go forward. But first, let's touch on PPI. So PPI inflation increased in August by 0.7, the fastest since June, while core increased by 0.2. August PPI went up 1.6% year on year. But here's the important pieces. So ex-food, 0.2, but PPI final demand is that 1.6 versus 1.3. And then when you exclude food and energy, you're still at 2.2%. So core never really cracked. You had two small down periods, but now you're starting to see that acceleration. A lot of this is energy. A lot of this is the follow through, and we don't see that stopping, which is why when we turn to inflation on a year over year basis, yes, it is lower than 2022. But that's why the year over year is a flawed metric to only look at. You have to look at it again to look at rate of change, where I'm not saying you shouldn't look at it, but it's something where the benefits or that hard comp is starting to normalize. So that means that you're going to get what is going to look like a reacceleration even on a year over year basis as the month over month continues to catch steam. So core CPI came in at 4.4%, FRB Cleveland median CPI at 5.7%, still above core CPI. Atlanta Fed sticky CPI at 5.3%, core PCE 4.2. So when you look at the pivots, all of these things are showing an anchor to this core CPI piece, to the core PCE piece, which is, again, is going to keep the Fed active in terms of trying to get in front of it. Worth remembering that super core inflation looks different for CPI versus the blue. So CPI is that blue piece, but then when you look at that core PCE, the orange, we've just been going sideways. We have not had a meaningful drop like we've had in CPI, which is going to keep things problematic. Growth rate for wage inflation adjusted average hourly earnings hooked lower in August from 1.1% to 0.5, still broadly in line with long-term average for now. But you can see it's a problem because you have the real wages coming down as we are getting that reacceleration. On month-over-month basis, increased August headline CPI increased at 0.6 versus the estimate of 0.2. Core came in at 0.3 versus the estimate of 0.2. And then obviously on a year-over-year basis, it accelerated. And to our point, August was the beginning of that acceleration. We see it again in September. We're likely going to see it again in October. And that's going to be a bigger problem, which is why we do think, even if we don't get a rate increase this month, we do think we're going to get one in November. August CPI core services, less housing or super core, confirming a reacceleration with 0.4% month-on-month increase. But again, look at that even on the super core level, or again, that however you want to do it, CPI nothing. You get an idea that we have not had a drop in month-over-month prices. When you look at the chart from earlier, we haven't had a drop in prices for core CPI since May of 2020. So since May of 2020, prices every single month have gone up versus the previous month. That is a massive increase when you look at where we are, and now you're seeing that reacceleration ahead of it. So then when you look at owner's equivalent rent portion of August CPI came in at 0.4% month on month, which took year over year change down to 7.3%, but still at an elevated level. And we'll talk about how it's still at the higher point. Now, when you look at that breakdown, CPI select categories, obviously gasoline came in at that 10.6%, fuel oil, airfare, it's what we've been saying. A lot of this is energy driven, but that starts there, and then it bleeds into services, then it bleeds into manufacturing, then it bleeds into other components, which is not going to go away. Then you look at food, hospital services, all of these pieces going higher, which again is going to impact not only where inflation is going, but also how people are spending.